Safe trading is crucial for beginners. When you first step into the world of trading, it can be overwhelming. The stock market is a complex and dynamic environment, and without proper precautions, you can easily find yourself in a precarious situation. Just like you wouldn't drive a car without wearing a seatbelt, you shouldn't trade without understanding the basics of safe trading practices. It's like wearing a seatbelt in a car. A seatbelt is designed to protect you in case of an accident, reducing the risk of serious injury. Similarly, safe trading practices are designed to protect your investments from significant losses. They act as a buffer, helping you to manage risks and navigate the market more effectively. It protects you from potential losses. By implementing strategies such as diversification, setting stop-loss orders, and staying informed about market trends, you can mitigate the risks associated with trading. These measures are your first line of defense against the unpredictable nature of the stock market. The stock market can be volatile, and it's important to be prepared. Market fluctuations are inevitable, and they can be caused by a variety of factors, including economic indicators, political events, and changes in investor sentiment. Being prepared means having a plan in place to deal with these fluctuations, so you can make informed decisions rather than reacting impulsively. Safe trading practices help you navigate the market confidently. When you have a solid understanding of risk management and a well-thought-out trading plan, you can approach the market with confidence. This confidence allows you to make better decisions and avoid common pitfalls that can lead to significant losses. Think of safe trading as your financial safety net. Just as a safety net provides security for a trapeze artist, safe trading practices provide security for your investments. They ensure that even if you experience losses, they are manageable and do not jeopardize your overall financial health. It's about minimizing risks while maximizing potential returns. The goal of safe trading is not to eliminate risk entirely, as that is impossible. Instead, it's about finding a balance between risk and reward, so you can achieve your financial goals without exposing yourself to unnecessary dangers. It's not about getting rich quick. Many new traders fall into the trap of chasing quick profits, only to end up losing their investments. Safe trading is about taking a measured and disciplined approach, focusing on long-term growth rather than short-term gains. It's about growing your wealth steadily over time. By adopting safe trading practices, you can build a strong and resilient portfolio that grows steadily over the years. This approach not only helps you achieve your financial goals, but also provides peace of mind, knowing that your investments are well protected. Remember, slow and steady wins the race. Just like the tortoise in the famous fable, a slow and steady approach to trading can lead to long-term success. By prioritizing safety and making informed decisions, you can navigate the stock market with confidence and achieve lasting financial growth. Diversification is a key principle in safe trading. It means spreading your investments across different asset classes. These include stocks, bonds, and real estate. Diversification helps reduce risk. Imagine investing all your money in one stock. What happens if that stock plummets? You lose everything. But if you diversify, you spread the risk. If one investment goes down, others might go up. Risk management is essential for safe trading. It involves identifying, assessing, and controlling potential losses. One way to manage risk is by setting stop-loss orders. A stop-loss order is an instruction to sell a stock when it reaches a certain price. Stop-loss orders limit your losses. They automatically sell your stock if the price drops below a predetermined level. This prevents you from losing more money than you're comfortable with. Section 4. Research. Knowledge is power in the stock market. Thorough research is crucial before investing in any stock. Don't rely on rumors or follow the crowd blindly. Take the time to understand the company. Look at their financials, their management team, and their competitors. Read analyst reports and industry publications. Understand the company's business model and growth prospects. The more you know, the better equipped you are to make informed investment decisions. Section 5. Practical tips for beginner traders. Trading can be an exciting yet daunting venture, especially for beginners. But with the right approach and mindset, you can navigate the complexities of the market and make informed decisions. Start with a demo account. This is a crucial first step for any aspiring trader. A demo account allows you to get a feel for the trading platform and understand how trades are executed without the pressure of losing real money. It allows you to practice trading with virtual money. You can experiment with different strategies and see how they play out in real-time market conditions. This hands-on experience is invaluable for building your confidence and honing your skills. This helps you understand how the market works without risking real money. You'll learn to read market data, interpret charts, and recognize patterns that can indicate potential trading opportunities. Once you're comfortable, you can start with a small investment amount. It's important to manage your risk and not invest more than you can afford to lose. Starting small allows you to test the waters and gradually increase your investment as you gain more experience. Another tip is to understand market trends. Keeping an eye on market trends helps you make informed decisions about when to buy or sell. Trends can provide insights into the overall direction of the market and help you align your trades accordingly. Learn about technical analysis and fundamental analysis. These are two key approaches to analyzing the market. Technical analysis focuses on price movements and trading volumes, while fundamental analysis looks at the underlying factors that influence a company's value. Technical analysis uses charts and patterns to predict future price movements. By studying historical price data, you can identify trends and make predictions about where the price might go next. This can help you time your trades more effectively. Fundamental analysis looks at a company's financial health to determine its value. This involves examining financial statements, earnings reports, and other key indicators to assess whether a stock is undervalued or overvalued. Combining both technical and fundamental analysis can give you a more comprehensive view of the market and improve your trading decisions. Section 6. Real-life examples. Learning from others' experiences. Let's say you invested all your money in a tech startup because everyone said it was the next big thing. You were excited, filled with hope and anticipation, believing that this investment would change your life. The startup had a lot of buzz around it, and it seemed like a sure win. Friends, family, and even financial news outlets were all talking about its potential. You felt confident and decided to go all in. But the company's product failed, and the stock plummeted. The initial excitement turned into anxiety as you watched the stock's value drop day by day. The news started reporting issues within the company, and soon it became clear that the product wasn't going to succeed. The market reacted swiftly and the stock price took a nosedive. You lost all your investment. The financial hit was hard, but the emotional toll was even greater. You felt a mix of regret, frustration, and disappointment. It was a tough lesson to learn, but an important one. This is why diversification is important. Diversification means spreading your investments across various assets to reduce risk. By not putting all your eggs in one basket, you protect yourself from significant losses. A diversified portfolio can include stocks from different sectors, bonds, real estate, and other investment vehicles. On the other hand, imagine you invested in a basket of stocks across different sectors. This approach allows you to benefit from the growth of various industries. While one sector might be underperforming, another could be thriving, balancing out your overall returns. Some investments did well, while others didn't. This is the nature of the market. It's unpredictable. However, with a diversified portfolio, the impact of poorly performing investments is cushioned by those that are doing well. Overall, your portfolio remains stable. The ups and downs of individual stocks are smoothed out, leading to more consistent growth over time. This stability is crucial for long-term financial planning and peace of mind. This is the power of diversification and risk management. By learning from others' experiences and applying these principles, you can make more informed investment decisions. Remember, the goal is not just to maximize returns but also to manage risk effectively. Diversification and risk management are key strategies for achieving financial success and security. Section 7. Trade smart, trade safe. Safe trading is paramount for beginners. Remember to diversify your investments, manage your risk, and do your research. Start small, learn from your mistakes, and never stop learning. The stock market can be a roller coaster ride, but with safe trading practices you can enjoy the ride while protecting your financial well-being. Trade smart, trade safe, and watch your investments grow.